This is the anatomy of a deception that generated $11 billion of corporate wealth by rewriting the internal accounting rules. In the late 1990s, WorldCom stood as one of the fastest-growing telecom companies in America, expanding its physical network at a relentless pace. Wall Street investors were enthusiastic. The company reported rising profits, and the stock price climbed predictably in response. On paper, the financial health of the corporation appeared flawless. That pristine balance sheet created a level of trust among regulators and the public that went largely unquestioned. But the public ledger did not match the private reality. Behind closed doors, operating costs were eating through the company's capital, and WorldCom was losing money. CEO Bernard Eber's space faced a specific mathematical problem. If the market saw the actual balance sheet and realized the company was operating at a loss, the stock would crash instantly. Instead of fixing the underlying business flaws, leadership decided to alter the financial records, setting the stage for systemic fraud. This technician represents WorldCom's massive daily network maintenance costs. In standard accounting, these bills are operational expenses, which subtract directly from a company's profit. On a ledger, daily network costs leave a massive negative red deficit. To hide this, leadership pulled those bills out of the expense column. By relabeling them as long-term investments, the expenses vanished. Instantly, the massive losses were replaced by a multi-billion-dollar profit. They conjured profits out of thin air by moving a number from one side of a page to the other, without improving the actual business. Investors, trusting these manufactured numbers, poured billions of dollars into the stock. Leadership repeated this trick quarter after quarter. Over time, the scale of the deception grew until they had accumulated $11 billion in fake assets. The larger the fake numbers grew, the more impossible it became to ever tell the truth without destroying the company. The illusion held until internal auditor Cynthia Cooper noticed that the finalized numbers looked too clean. She began a quiet, late-night investigation, looking past the finalized reports to dig into the raw, line-by-line data. Deep within the system, she found the exact mislabeled expenses buried in the investment accounts. The $11 billion discrepancy represented a deliberate, systemic fraud engineered by leadership. One person looking at the raw data was able to dismantle a multi-billion-dollar corporate fiction, proving that the math eventually demands the truth. In 2002, the public admission of the misclassified expenses forced the company into an immediate financial correction. Because the $11 billion in investments were actually just spent cash, the company's value evaporated overnight. WorldCom filed for bankruptcy. The collapse wiped out billions in investor savings and cost thousands of employees their jobs. CEO Bernard Evers was ultimately convicted for his role in organizing the massive accounting fraud. He was sentenced to 25 years in federal prison, a final cost for hiding the truth instead of facing it. Corporate ledgers are merely representations of reality. While numbers on a page can be manipulated for a time, the market and the math will always, inevitably, correct the record.